Good morning, everybody. Welcome to the morning kappa at 8 on a Wednesday, and also welcome back from a long weekend. So I'm here to present the midweek futures traders technical brief, and we are on week 3, September 2025. Okay, so this is a very familiar table that we refer to every single week on the morning kappa, and this table has seen a shift from a lot of the neutral setups to positive currently. And as mentioned before, neutral setups are very important for markets as the market determine the next course of action. And for the week between week 2 and week 3 of September, we have seen that most markets have moved from a neutral position to positive. And those which has turned from neutral to positive are basically the Hang Seng Index, the Nasdaq, the S&P 500, and the Nikkei. And one of those very important bottoming out actions that we have seen is in the agri sector, whereby soybean oil and soya bean has turned from neutral to positive. Only crude oil is remaining in neutral, and including our palm oil. So I'll move on and we look at palm oil here, and palm oil prices basically have been trading on very neutral ground. We have seen that palm oil inventories have climbed to a 20-month high at the end of August on higher production and also softer exports. MPOB data showed, and this will be a determining factor on the price actions that we will basically to be content with during the week itself. Cumulative output for July and August was actually 1.87% lower than the same period, and this is an indicative that maybe the production side is not meeting expectation, and this could be the supporting factor for the remaining of this week. For the commitment of traders, US indices, the S&P 500 has seen an increase in short positions by an estimated of 9,000. The Nasdaq and the Dow Jones also saw a slight reduction in net long positions. For the S&P 500, the index have notched a series of records in recent weeks, in part due to investors' enthusiasm over the prospect of lower interest rates, which many are betting will reheat the economy. The central bank is widely expected to cut rates by a 0.25 percentage point on Wednesday, when federal officials conclude their 2-day meeting. Investors are also eager to read the Federal Reserve's dot plot, which shows officials' rate projections through the end of the year, and also to gauge Chairman Jerome Powell's tone as he answers questions about the economy. So that would be one of the factors, which many of the investors are looking at. And as seen from the chart above, we are noticing that prices have actually been trending up. It's been followed by very shallow corrections, and eventually higher highs have been achieved. So this is likely to be the pattern for the moment. But for short-term wise, we are looking at a possible short positions as the Federal Reserve meeting will determine whether interest rates will be reduced by 25 basis points or the 50 basis points that Donald Trump is talking about. So currently, the profile is positive and the short-term setup is negative. Current price is at 6674, and the reference price for this particular setup is 6649. And the potential profit price for this setup is 6590, giving us a value of $295, and also a potential loss which is above the 675, giving a value of a loss USD $330. For commitment of traders, we're looking at the agriculture as well. And for agriculture, basically, we saw very mixed movement in positions. Corn and soybean meal had shorts increase over the week. Wheat added to an estimated of 7,000 to its overall long position, whereas soybean and soybean oil saw a reduction in shorts by an estimated 4K and 9K. So we're going to move on and look at soybean oil because indeed, if we look at what has been happening, the soybean oil pattern is seen to be bottoming out as the bearish stance over the past 2 months in view of bumper harvest looks to be fully imputed. The action of discounting bad news does look in play in the current situation, and thus the current rebound and bottoming out pattern that we are observing here. So we will look at the guide for soybean oil here, and profile-wise, it has turned positive, and also the short-term chart setup is also positive. Current price for soybean oil is at 53.19 and reference price 52.70, which means that we are looking for a slight correction for this setup to be valid. So if this happens, the potential profit price that we're looking at is 54.0 and giving us a value of USD $780, and also a potential loss price which is below the 51.80, giving us a potential loss of USD 540. So this is all I have for this morning. I'll pass on to the next speaker. Thank you.
All right. Thank you, Vincent, on the weekly index futures review. Looking at the Hang Seng Index, I can see that Hang Seng continue on the upside movement, and right now it's eyeing the 27,000 point level. Just recap what happened over the week, right? During we have the daybreak. Over the week, this US the negotiation team led by Vincent have reached a deal with China, right? Especially on the TikTok. So this coming Friday, Trump is going to speak to Chinese leader Xi Jinping, and sentiment remains bullish, and as we can see from the Hang Seng Index overnight, yesterday night, even at the evening sessions, right? The index have remains on a higher high closing date, and so on side support remains at 23,800 point level. The immediate support is 25,000 point, and on the upside, 27,000 points of immediate resistance. Likelihood this week or next week, right? We shall see a bullish breakout upon this 27,000 point level, right? And as we mentioned, right, to lift the index higher, we should look at some of the index member, and you can see that last week, or in fact for the last 2 days, flow continued moving into the Hang Seng Tech Index. So rather than the conventional stocks market is actually looking for the tech stocks. Last week we mentioned about the GDS during our morning kappa sessions, and you can see that GDS have surged up and break past the R2 second resistance at 38, and of course right now after the breakout, it has a mild pullback, but still remains above the 30 Hong Kong dollar support. As you can see that the GDS volume profile, right? All this volume has been traded at 32.50 cents. And previously, we also mentioned about the Johnson Electric. You can see that the while the stock has been moving upwards, the most of the volume has established just below the 22 level. So this 22 is a very strong support, and true enough, last week, Johnson Electric have another uplift. It break past the 34 Hong Kong dollar. So continue to follow our trading report as well as the stocks that we mentioned during the morning kappa at 8. And last week, our report also have mentioned about Alibaba. So I think that the sentiment remain bullish, and Alibaba should lead the tech stocks in the Hong Kong market. So apart from Alibaba, right, another say if you're looking for a breakout stocks, right, yesterday I do see Cine Glass have staged a breakout as well. You can see that on the Cine Glass, just below the 825, that's where most of the volume has been traded. As such, I have added Cine Glass into our watch list. I've not added any stock for some time, and this morning I just added into our watch list. Okay. Now, apart from that, I think two stock will be very interesting. Firstly, is the Trip.com 9961. Last week we mentioned about their peers, Tongcheng Travel, and this week we'll be looking at the Trip.com, which in Chinese word is called Xian. Right, if you are going for China, definitely you use their app to book your hotel and your travel. So after the breakout from 570 Hong Kong dollar, Trip.com is eyeing to test 620 and followed by 650. Downside supports are 540. Apart from Alibaba, we'll be looking at the Hang Seng Tech Index member, Tencent, which is stock code 700. So Tencent have a break past of 630 and right now heading towards 670 and followed by 700. Downside support is at 600. So in the tech space, I'll be looking at these two index member, Trip.com as well as the Tencent. So tonight is the Fed interest rate decisions. Important is that we want to look forward for next year 2026 interest rate guidance. And apart from that, yesterday I think the Israel have launched their ground offensive on the Gaza city, and that actually have see the oil price have actually went up, and right now are heading towards the $65 resistance again. But for oil, still remain a bearish bias until it break past the 67 resistance. As for the Europe market, yesterday it has experienced a very strong selling pressure. I think also due to the this Israel news. Right, market have turned a little bit of cautious mode right now. But for the real market, you can see that for the last 3 months, the stock has been consolidated and breakout. So very strong support has formed at the 535 level. So as long as stay above 535, right, I think the overall technical setup remains bullish. As for the US market, continue to move on a higher high, and yesterday night it break past the 6,006, just pending the FOMC meeting tonight. Then on for some of the US stocks, you can actually look at the LE Financial. We break past the 42 US dollar, and then the Tesla also break past the 400 US dollar resistance yesterday, right, on the news that the Musk is buying back the Tesla shares. Now looking at the Tesla, right, what we have learned here is that the volume has been traded at the 340 level. So after the breakout, right, that is a very thin resistance on the upside, right? And so another counter we'll be looking at will be GE Aerospace. I can keep it in the watch list. As for Malaysian market, best performed was utilities, telecommunications, and technology. We still keep a bullish bias on the FKLI and the FCPO. We also have a bullish bias as well. So after the last week, the MPOB meeting, right, we just raised our stop loss from 4250 to 4350. And as for the FCPO, right, we just keep a bullish bias, yeah. And on the technical trading stocks today. Firstly, we'll look at the Inari, which break past 2 ringgit and 5 cents resistance. After a breakout, Inari will be testing 2 ringgit 15 cents and followed by 2 ringgit and 25 cents. Downside support is 1 ringgit and 95 cents. Secondly, we have the Eco development, which break past 2 ringgit 17 cents, and next resistance is 2 ringgit 26 and followed by 2 ringgit and 33 cents. Downside support is 2 ringgit and 10 cents. So we have two breakout stock, Inari and followed by Eco. So I'll stop here and I'll pass on to the next presenter.
Thanks, Joseph. Thanks for joining the call. We are presenting our economic weekly report published last Friday. So we have seen some increasing black swan events in frequency over the last week, including Israel attack on Doha, Russian drones attack on Ukraine, and riots in Indonesia as well as Nepal. So at these junctures, market watchers are taking things in stride, including equity valuations may continue to point higher, but it remains unclear whether the risk premium will also rise. So we refer to our back to our report in April 2024, where we see that escalations in the geopolitical retail risk may mean that first, lower USD yields, second, higher gold price, and third, higher crude oil price, as market watcher may tend to turn defensive to play defensive post during post tensions periods. So on the rate side, we see that trader may continue pricing 100 and 107/4 probability of a 25 basis point cut on 17th of September, which is today. So beyond September, market also pricing another 25 basis point cut in October and December. This translating to a total 3 cuts by year-end. However, we think that this is slightly mispriced, where we keep our view for only 2 cuts for 2025 under 2 reasons. First, our Taylor rules analysis suggests that only 1 cut in 25, while and second, our US-centric inflation pressures may persuade the policymakers to avoid cutting too fast, and the risk-elevated price pressures in the medium term could support on that. On Malaysia side, we have also published a SORA report on which reinforce our forecast for 3-month SORA to move towards 0.85% for this year, with our OS model suggesting that FR is the key determinant, followed by Sing dollar. In Malaysia, we expect the 3-month CIBOR to remain flat at current levels around 3.2% for the remainder of the year, in line with expectations for the OPR to remain unchanged over the same period. That said, we still see some slight upside to 3.3% for the CIBOR, in view that's the typical seasonal uptick in fourth quarter. For Indonesia and Thailand, we see pricing also in another rate cut early in fourth quarter, suggesting there's some downside over short-term interest rate bank rates. For DXY, we expect DXY to be slightly biased lower in these coming weeks, with a support at 96.78 and another S2 at 95.2. However, resilient retail sales could cap loss and keep it range bound with a resistance pencil at 98.15 and R2 at 98.6. So the bearish sentiment that drove the XY into the 97 zone this week, fueled by labor market cracks, softer economic data, as well as political pressures from the Fed, which may drawn further down. At the same time, sticky inflation may complete the scope of deeper easing, despite a cut this week could be locked in. So USD 10-year yields may see further downside bias below 4% in the coming week as investors react toward a cut today. In addition to this, risk premiums may pressure the yields lower on the back of safer demand, as I mentioned earlier. So for this week, we have a kind of important central bank policy meeting this week, including Fed, where we see a cut of 25 basis point. Bank of England, BOJ, and BI, we think they will likely keep unchanged. Other than that, we have Chinese retail sales, internal productions, and fixed asset released on early this Monday, as well as US retail sales and industrial productions on yesterday. But today we have export oil domestic export from Singapore, and as well as Malaysia trade on 19th of September, which is on Friday. That's all from me, and I would like to pass to the next speaker. Thanks.
Hello everyone. Morning. Nabil here. Thanks for joining us this morning. From my side, I have a report on MBSB. Interestingly, it is an upgrade to a buy from a neutral, and now we promote MBSB as our preferred pick among the domestic-only banks. So this report was originally intended to be a post-event report following MBSB's Investor Day last week. But that event mostly discussed longer-term strategic plans. In short, MBSB still remains focused on CASA acquisitions. This, they think, is the first step towards catalyzing other improvements in the bank, such as financing diversification, better asset quality and margins, etc. So on CASA, MBSB are competing on both price and non-price fronts, i.e. addressing customers' pain points. For retail banking, they've identified remittance as an area that is currently underserved by existing banks. And for the commercial customers, cash flow tracking is also a pain point. And so to address these issues, MBSB is leveraging on third-party partnerships with names such as Wise and Bayo in order to offer these value-added solutions. So that's really it for the strategic part. But now on to our thesis for the upgrade. In terms of MBSB's FY25 guidance, these were kept. Namely, the bank is looking at net interest margins of over 2%, financing growth of 5 to 6%, and ROE of 5 to 6%. If you look at where they were at the halfway point of the year, they were trailing both on the loan growth and ROE fronts. But this was more or less guided for earlier, as management has spent its first half 25 recalibrating its credit underwriting standards, etc. So the second half of the year is expected to see an acceleration in financing growth, as evidenced by recent news flow. And this loan growth is positive for both margins and ROE. The recent OPR cut might be a slight stumbling block, but management is still retaining its guidance as, it has mitigating factors from the stronger loan growth and better non-interest income opportunities. In terms of capital management, MBSB sees two routes for the optimization of its excessive CET1 capital ratio. The first being above industry loan growth, and the second being elevated dividend payouts. Recall that in the first half of the year, they paid out 2 cent interim DPS, which translates to about a 92-93% dividend payout ratio. This so happens to be the third consecutive payout around the 90% mark. So even though management had guided for that 90% payout for a while back, we only now turn a bit more comfortable with raising our payout ratio assumptions to that level, given the more convincing track record, so to say. So against our earnings forecasts of about 16% 3-year earnings CAGR, the dividend yields go up to 8 to 10%, which is the best in the sector. And we think this is sustainable, given where capital levels are. And this should allow the capital ratios to slowly fall down closer to peer levels within 3 to 4 years. So yeah, dividends form the key thesis for our upgraded buy call. But in terms of a strategic near-term positioning, we also think that MBSB is the least negatively impacted bank by the OPR cut, given that it has a sector low CASA ratio of just 10%. What this means is 90% of its deposits will be repriced down by 25 basis points. And this will help to offset any of the lower asset yields from the OPR cut. So, from the report, we upped our earnings forecast slightly by 2 to 6%. But again, we raised our DPS assumptions higher by over 30%. as we now factor in a higher dividend payout ratio assumption of 90%. Our earnings forecasts are now closer to consensus versus previously when they were almost 10% lower. So with that, we also raised our target price to 79 cents. And this is based on a mean price to book of 0.63 times. Sorry, 0.64 times. So yeah, we are breeding MBSB to a buy again from neutral, and we promote it as our preferred pick among the domestic-only banks. So that's all from me. Thanks so much for listening, and I'll pass on the floor to the final speaker. Thanks.
Hi, good morning. Today we have a report on KLK. This is a update of news flash where they talked about where they decided that they want to develop a technology park in Tanjung Malim. This is going to be called our KLK Tech Park in Tanjung Malim, and it is a 1,500 acres integrated hub comprising of 1,300 acres of land for industrial development, as well as 200 acres for residential support. And this will be developed over a period of 10 years from 2025 to 2035. Basically, this land is located strategically near the Automotive High-Tech Valley Park and has direct access to the North-South Expressway and also very close to Tanjung Malim town. This land will be developed or will feature build-to-suit solutions, industrial plots, as well as ready-built factories. So for this first phase of land, they have actually already secured their first anchor tenant, and that will be BYD Auto. And this BYD Auto will take up 150 acres of land, and they will build their plant there. And that will be completed by the end of 2026. This plant has actually already commenced construction at the end of August. So this phase one of the land, we understand, is an outright sale to BYD. So they will provide them with basic infrastructure, and then for phase two, this will include a 200-acre vendor park, which is aimed at the auto and manufacturing players, and is set to be launched by end of 2025. So overall, the GDV for this whole integrated hub is projected to be about 3.5 billion ringgit. So there are no details actually other than what I've just mentioned, but based on our estimate, given KLK's low holding cost of less than 1 ringgit per square foot, we estimate that the margin for the land sale to BYD could exceed 50%. Because if you look at current market prices for land in Tanjung Malim, it's currently ranging between 30 to 40 ringgit per square foot. So phase one alone, which is 150 acres, we estimate could bring in 100 to 120 million in profit to KLK, which will add about 7 to 9% to the FY 2026 net profit. As for this phase two, we expect to see medium-term contributions from development income, where they will be developing it and via a combination of land sales, as well as build to sell, build to suit, as well as build to lease. So basically, this will give them immediate income in the form of disposal gains, as well as recurring income in the form of property development profit, as well as potentially rental income. But again, we are unable to estimate what the contribution could be because there's not much details on this at the time of writing. So we made no changes to our earnings forecast at this point, or our target price, which is 21.50. We continue to have a neutral call, however, on KLK, although we are positive on this tech park, given that valuations we believe are relatively fair, where it's trading at around about 19 times FY 2026 PE, which is closer to the high end of its peer range, which is 17 to 20 times. So that's all that I have today. With that, we thank you for joining us today. Happy trading, and see you again tomorrow at RSB Morning Kappa at 8.